The global risk mood remained firm this week, with equities rallying and the US dollar modestly stronger. This was perhaps a surprise as media and markets were captivated by the Trump-Putin summit, while commodities fell as trade tensions rumble on and threaten the growth outlook. Certainly, much of the focus was on the Trump-Putin summit, and while political intrigue was high, market reaction was fairly muted. In fact, price action in currency and interest rate markets suggests the quiet Northern Hemisphere summer trading conditions are already upon us earlier than usual. However, President Trump did cause a stir later in the week when he broke with long-established protocols and commented on Fed policy, saying he's not thrilled about rates going up. He also bemoaned the US dollar strength and said the Chinese currency is falling like a rock. Now, the White House quickly clarified the president respects the independence of the Fed and is not interfering with their decisions. Nonetheless, the US dollar was trading around a one-year high before pulling back sharply on his comments. The British pound was the weakest G10 currency this week and continues to be weighed upon by Brexit and political negotiations. The UK data this week has seen lower than expected inflation and retail sales for the month of June, although retail sales for the second quarter as a whole have been more positive. This uncertain backdrop certainly adds to the challenge facing the Bank of England at their upcoming meeting in a fortnight, given a historic descent at their last meeting, although the market's still pricing around 80% chance of a hike. Domestically, this week saw the RBA minutes of their July meeting, which emphasised that policy remains firmly on hold, although it did contain a detailed discussion of household debt dynamics. Again, the RBA said their next move would more likely be an increase than a decrease, although they reintroduced the notion that a stable cash rate would be a source of stability and confidence. However, the key Australian data release was very strong employment data for the month of June. Australian employment increased by 51,000 in June, well above expectations, with full-time jobs contributing most of the gains. Although the unemployment rate held at 5.4%, as the participation rate rose as workers were pulled into the workforce. This responsiveness of labour supply does show why wages have been slow to respond to this employment strength. And while this was a strong result, momentum is still slowing from the peak in employment growth we saw in 2017. Next week brings a number of important events globally and locally. On the international front, we see US Q2 GDP, which is shaping up as a cracker given current consensus forecasts of around 4%. We also see the flash PMIs on Tuesday, as well as the ECB on Thursday, who at their last meeting emphasised a commitment to keep rates steady until at least the summer of 2019. Domestically, the highlight will be the June CPI print. Our economics team is expecting another benign print, and it is worth noting for the last 18 months, consensus forecasts have overestimated inflation outcomes, and inflation remains far from threatening the RBA outlook. All up then, the US dollar looks to be supported by the GDP data, while the US tariff hearings continue next week. The market will be focused on China's potential response. If the yuan continues weakening, then this could put further pressure on the Australian dollar, although it should remain close to 74 cents. We'll be back to talk to you next week.